working. It's working. What's good, everybody? How we doing out there? Welcome. Just letting it connect here. Always takes a minute for things to adjust. And plus, I'm by myself here tonight, so the wine is all for me. It's all for me now tonight. I love it. So, hey, welcome. If you're joining us here publicly, you should have access and be on in here. I hope you got a drink and ready to hang out with me. I got my wine of wealth. That is our special drink there. I'm just going to pop on over here. Yeah, we call it the wine of wealth, man. It's by Jazz Wealth, but it's real small. You got to look in there real close. My 40-year-old eyes, man. It's actually pretty good. Anyways, welcome. Trying to do something a little different here today. It's also about to storm really bad, as is typical this time of year around here in Florida. So I won't, take a lot of your time. I always like to use the Wine and Wealth class as a, get right to the point, and then I'll hang out and answer questions as long as you like. I genuinely have nothing else to do, and so I am here and happy to help in any way I can. This class, it's Wine and Wealth, right? I mean, this class typically is sort of reserved for clients and sometimes research members. Our goal is to strip back all the nonsense, right? Strip back all the intimidation. I'm a financial advisor guy, right? I don't like doing that. So we figure what a better way to do that than to come hang out in our speakeasy here, we call it, with a glass of wine or Kool-Aid or whatever it is you like to drink. As long as you're enjoying yourself, then I'm cool with that. You know what I mean? That's the whole goal. I got a lot of different things to cover here tonight, so I don't want to waste any time. But if as I'm going along, you are watching this and you're not a client or something, and you go, well, that's kind of interesting, check us out. jazzwealth.com. You can schedule a call. Eric's just sitting here just waiting for people to call. But you can schedule a call, send an email, ask some questions. We are as transparent as you can be. I always tell clients, there's no question I won't answer. There's no question anybody here won't answer because it's all public record. So there's nothing we should have to hide. There's things I can't say, right, about what to buy a stock or, things like that I get in trouble for. But yeah, any question goes, right? So feel free if you have any questions about us or about anything I talk about, then yeah, you know what to do, right? You know where to find us, and we're trying to really put ourselves out there as hey, we're just here. Right? If you see the value in us, great. If you don't, that's cool too. I hope you learned something because we got a lot to talk about. Because I don't know if you saw the market. Hey, anybody? I don't know if you've seen what the stock market's doing lately, but it's naturally stirring up a lot of emotion. The first thing that I want to share with you today is, under no circumstance do you watch the market and your portfolio fall and then you take some kind of action. So clients here at Jazz Wealth, we haven't been falling as much as the market, not nearly as much as the market. And that's because in November, December of last year, we noticed we were dramatically outpacing the market. And we said, well, either A, I could just leave it like that and have everybody go, woo, look at Dustin go. That Jazz Wealth is something special. Or I could plan ahead and I could say, guys, we're moving faster than we need to with our investments. Let's slow down. We're not timing the market. Let's just slow down. It's running hot, right? And so now this year, all the way through this part of the year, it's we've had that cash in many of our funds over 30%, cash just sitting there waiting for the discount. So we only had 70% of our portfolios falling with the market. So you get an idea of how we're not falling as fast. But what comes up is people go, oh my gosh, the market's down 23%, going on 25%, and I'm nervous. My 401k is dropping and all this stuff. And is there any option to go to something more conservative? No, big mistake. And I'm saying this as generally as possible. Take financial advisor hat off for a second, just average guy, right? So if you are moving at 100% or 100 miles an hour on the way down, stock market's going 100, you're going 100, and you fall. And then you say, now I'd like to be more conservative. Think about what happens. You just now slow the speed of your portfolio down, but you didn't stop the market. So the market's going to recover at some point, and it's going to keep moving the same pace it always does. But now you're dragging behind because you slowed down. We only slow down your portfolio on the way up. I would rather have you slow things down on the way up and find out you're a year too early than have you watch a plummet, then slow down. And here's one of the reasons why. This is probably just going to... Told you. I knew it. So I'm going to pop over here. So give me just a second here. And I'm going to go like this. That way we know it works. Okay. You've seen this. This is not like magic or something you've never seen before. I'll show you some stuff you've never seen before, but this is the first one to just wet the whistle a little bit. We're down, let's call it 25%. If you slow down, you not only need to make back 33%, but you've got to make back more than that because you slowed down. This is saying if the portfolio, if your investment falls 25%, then we need a 33% rally just to get back to scratch, right? Back to where you were. But if you slow down in the meantime, now you need even more. And that's the worst feeling in the world, man. It's worse than watching your portfolio fall, I'll be honest. I mean, when you start to see things come back and you're not coming back with it, you go, I kick myself, you know? And we always have clients that do that, and despite our best advice and all that stuff, I mean, eventually there will be somebody that watches the market fall 25, 30% and says, that's it, get me out. Horrible decision. And I'll even tell you, I mean, I have nothing to gain from it, so I just tell you, that's a horrible decision. If you want me to do it, I'll do it. But that is a horrible decision, and now you know why. You already have an uphill battle to fight. We all do. We all have our portfolios that need a lot of work, right? So why make it harder on yourself? And ask yourself, if the market fell 25%, what do you think's going to happen? Is it going to go down 90%? And if it does, like, don't we all have problems to deal with, right? So, like, what's the worry? What's the concern there? So just be very cautious. That's my first lesson of the day for you, which is just a sort of getting you started, right? Just a little easy one to get you started. Now I want to play a different game. I want to play reverse psychology on you. And this is actually something I've shared with clients. Let's try something a little backwards here. So I often share data with you that says when the market does this, then the average bounces this, the average whatever. You know what I mean? I give you that step. And it occurs to me that maybe we're looking at it backwards. Let's assume that the market, which is in a bear market, hits bear market territory, and now you say, I'd like to bet that it's going to continue. I'm nervous, I'm scared, and instead of running away, I'm going to bet that that thing's going to continue lower. What are your odds of success? It's actually very poor. You do not want to do this. So when the S&P hits a bear market, down 20% or more, if you were to say, I will bet that it will continue, over the next 1 month, you'd be wrong most of the time. You'd only be right 37% of the time. So nobody wants to bet on the market going lower after it's already fallen 20%. Statistically, if you did that over and over and over again, it's a losing battle. You'd have to return 3x what you lost in order to make it profitable, which is a whole separate class we did for clients on probabilities and returns. But would you do that? If I said the stock market fell 20%, and now I want you to bet on it going even further, but there's only a 37% chance you're going to be right, you wouldn't do that? What does that mean, though? It means that there's a 37% chance, as the markets have fallen, that that's close to the end of it, right? You're not going to be right on that as a long-term play. Now, look, as you go further out, 3 months, you got a 31% chance. So if me and you make a bet, you say the stock market went down 20%, Dustin, for the next 3 months, I will make a wager with you, and at the end of 3 months, we'll see what happens. I'm going to bet that it continues going lower, and Dustin, I will bet that it's going higher because I know I got a 70% chance of being correct. Look at how it gets worse over time. So this is another argument to make to say you don't run away from the stock market when it gets weak, right? You adjust on the way up if you have to or if you want to. And when we have those downturns, you make the most of it by getting in there and adjusting. Maybe you're rebalancing or adding some new things to your portfolio and finding, you know, good positions that you like. But there's no way you're going to bet on it continuing lower, right? So I point that out because we're in a bear market and potentially a recession. I'm going to talk about recessions here in just a second. Let's take a look at this. I'm going to cover every market. The S&P 500, 1 month after you hit 20% down. Is it scary, right? Is it like, for example, we hit 20% just the other day. So let's take every other time that's happened and then just look 1 month forward and say, what happened from here to there? Did we go further down? Did we go higher? What happened? Well, 2020 is an outlier, right? This one should almost not even be included. It's skewing the average a little bit because that was COVID. So COVID, we fell. It was a 33-day recession. That was the shortest ever in history. And then we just started recovering. That's not what's going to happen this time, by the way. So nonetheless, it was 12%. In other words, it meant we hit 20% down. If we fell asleep for an entire month and we came back, you're up 12%, right? That's not going to happen this time. I would bet that that's not going to happen this time. But what you see is that once the market hits 20% down, there's only a couple times that it's actually lower a month later. People like the 20% down. They like that opportunity to make their paycheck go through from their 401k, add a few more dollars. Imagine the whole world going 20% down. Maybe I'll just inch up my 401k a little bit. I was putting in 6, I'll put in 7%. Those extra dollars support the market, right? Not to mention fund managers that go, you got me a 20% discount and I have to perform or I lose my job. I better go buy something, right? So there's all that new money coming in. This time will not be different, and I'm not rah-rahing the market here. It just won't be different. So there's your stats there. The average one-month performance going forward is a gain of about 3.8%. Anytime it did continue lower after 1 month, it actually wasn't that bad, right? Another 1%, 2%, right? 196, 129, not too bad, right? Now, one of the things that I actually show, I do with clients is not so much about probabilities of a return. It's just kind of like seasonal performance. That's actually the words that you would use. You would say the seasonal performance of a particular index or of a particular pattern, maybe a time of year. You've heard of sell in May and go away until after Labor Day and all that stuff. So that's a seasonal study in the market. The Santa Claus rally, seasonal study in the market, right? Take a look at this. And I like showing these kind of things here. Let's take the, let me go back over here real quick. There we go. Let's go to the Dow. So we did the S&P there. I told you I'd talk about every market. Let's go to the Dow. Here is the monthly average change for the Dow. Just looking back 20 years. We do this for clients. I'll do 20 years, 50 years, and 100 years just because the Dow goes back that far. But check this out. Is June normally a positive month? Like out of all the months, there are 3 months in the market's year, a cycle in the year, that are down on average. And June is one of them. It's the second worst. So the fact that June is still down at the moment is not technically shocking. It's down way more than the average, I'll give you that. But it's not technically shocking there, right? So what happens next? July. It's not the best performing month, but it is one of the better performing on average, right? It tends to average a gain through the month of July. What did we just talk about? We hit 20% down, and we're going into a seasonal time period where the stock market's performance is strong. So if you didn't believe the last slide, and now you add this data on top of it, we got a recipe for saying, okay, this is kind of interesting, right? There's a reason that I might want to take a shot and buy some of this here. It could be totally wrong, right? We could just have a small gain in July, maybe no gain, right? But you have these little things adding up saying, all right, I gotcha, right? I see the 2 different indices already that you've talked about and how statistically and now, seasonally have strength coming up ahead here. If you look at the probability of being positive, you can see that June is the worst. Junes are just bad. This one just happened to be really bad. But Junes only are positive 40% of the time. Julys are positive 75% of the time. And the probability doesn't change much whether you go to 50 years or 100 years. We're just doing 20 because I wanted to throw something together for you guys, right? So we look at the Dow, we've got July on our side. We're not there yet. We've got July on our side, right? What else? How about the NASDAQ? Take a look at this. The NASDAQ it's 30% down, right? So the NASDAQ's down 30%. We can't use 20% anymore. We're long past that. In the last 1 month, it's fallen 10% already. So 30% off of highs. What happens going forward when the NASDAQ falls 30%? It's not horribly common, although it is more common than the S&P. But look what happens. Okay, we've got some average gains there. We get it. We fall 30%. It's a buying opportunity in the short term, mid-term, somewhat long term, right? So over 3 months, 17% is the average gain when the NASDAQ falls 30%. You can't miss that. Even if we only get 9% this go around or something smaller, those are gains you can't miss. And you know how we know that? Because if we look a little bit further, here's what the NASDAQ does just in general. So in any 1 week period, this is true, Any 1 week period, 0.2% is the average gain in the NASDAQ. I would have thought it would have been more myself. Over 1 month, the average gain is 1%. It's just a touch over 1%. Over 3 months, obviously the average gain is about 3%, right? So that's what it does normally if you're just turning a blind eye to the market and saying, I don't care, I'll just invest anyways. But after a severe decline, look at the severity of the returns relative to norm, right? That's why they say the biggest rallies happen in bear markets. Well, there you go, right? That's the history right there. There's no prediction here. That's what has happened. Right, so it's fascinating to see some of this stuff, right? Because now you got the S&P, you could put that data that we just showed you there. You've got, okay, well, maybe that's buying opportunity. We're looking pretty good here. You've got the Dow, the seasonal performance of the Dow. Ooh, all right, put those two things together. That's pretty cool. You got the NASDAQ falling apart over here, down 30%. But we know that returns or bounces tend to be more severe when that happens. We have 3 great reasons to look at the market and go, I don't know that I want to be all in here, but I have to take a shot, right? You can't run away from this. You have to run into it. I always tell clients, I run into the fire. I don't run away from the fire. And so if that makes you nervous, you may need to look the other way for a minute, because that's what we're going to do. Right? We did that in November and December as well. I'm going to sort of basically, scale out little by little. If you don't like this, you may want to, turn around for a minute. Turned out to be a cool thing there. Now, one other thing, let's go a little bit further here. Recessions. Big question. Everybody's, well, is it going to be a recession? What's happening, Dustin? Tell me what's going on here. Recessions. What does that mean? Right? This is an old slide. Actually, I was sort of excited when I found this here because this comes from the days of when I used to make like colorful slides and stuff, and now I'm just like, no, let's just get to the point. Recessions are determined by a decline in GDP in general. It's not the definition, it is just determined that way. The National Bureau of Economic Research is the one that actually places the official label and says, you know what we just, that back there, that was a recession. They're the ones that make that decision. It's a handful of people actually, but they're very clear that they don't decide that there's a recession simply by 2 negative quarters of GDP. They have a whole 3 different criteria. It's really cool. Well, I think it's cool. Anyways, so we said, okay, there's a recession there. Does it matter? This is pretty cool, right? See the chart? See what I do here? Do you really care? Like if you're a long-term investor, if you're a trader or something, you're just soaking this stuff up. But does it really matter if it's labeled a recession or not? Would you have been better off not knowing? So here we go. Here's a visual. This goes all the way through COVID, because this, again, I'm just an old slide here. What I did is we ran all the data points, and then we stole the data points from the National Bureau of Education Research, and we said, okay, what dates did they mark them as a recession? So in red is when the official recession was announced. In gray, in the background, is the dates of the official recession. Remember, it's a lagging indicator. So when we say recession, that's not the start of it. They're saying, oh, that stuff back there, that nastiness, we now realize that was a recession. So for example, right down in here, your red dot says, okay, recession was in fact officially labeled. We had already fallen. I know it's a little hard to see, but we had already fallen. We were already moving on our way there, right? Over here, recession officially labeled. We made a new low, but were we most of the way through? I got an interesting stat for you in a second. Last one, 2008, the recession labeled. If you waited to do something like get out of the market when the recession was labeled, you just missed the bottom. Sorry about your luck, right? This is a great slide to show that it really doesn't matter when they label it a recession. If you're already looking to get out and you get out because of a recession, you're missing the boat. There's one time you thought, ooh, I got it right there. Wasn't for very long though, right? And then, of course, we know the COVID one. It was marked a recession after the stock market was that close to hitting new highs, all-time highs again. Again, that's not going to happen this time, but that's what we had before. Here's a cool stat for you, and then I'll take your questions, get out of your way, and do that. By the time recessions are made official, they are usually done or close to done with, meaning when we make it official, we've already kind of gone through the nastiness, we're working our way out of it, as well as the stock market. The only time in history where a recession wasn't already 2/3 over with, in other words, like my little graphic down here, was the second dip in the early 80s. when in 81 to 82 the recession was declared, but we were only 40% of the way through that. That would be this guy right here. Oh, no, I'm sorry. That would be this guy right here. So there's two of them, but this is the second one here. We announced the recession. We were only 40% of the way through from both an economic and stock market perspective. We still made 2 new lows along the way. Otherwise, by the time over here, recession, you can't even see my hand. By the time the recession's announced, we're already on our way, right? So you don't want to be that person that's like, oh, you know, my uncle was talking to me and he just kept going and going and it scared the devil out of me and I just got out of the market because we were labeled a recession. Don't. You're going to kick yourself so hard. I promise, right? One of my my friend's parents, they were like my second client when I got started here. And, you know them a little bit from high school and stuff, but I didn't know them personally. So I've gotten to know them over time. And during the COVID drop, the husband, he's like, I don't know, this time's different, right? Every time's different. He's like, I think we need to get out. And I said, you can't afford to get out. No, you can't do it. I was really tough on him. And so a couple of days went by and he called and he said, we've been really thinking about this. We think we need to just get out of the market. I said, no, you can't. Like you don't have get out of the market money. It doesn't work that way. And so on March 23rd, I kid you not, on March 23rd, 2020, he called and said, we've decided we just want to get out of the market. And his name is Steve. So I said, Steve, you're going to have to come physically fight me to press the buttons to get you out of the market because there's not a chance this is happening. And that was the day of the bottom. Who's been there, right? Not physically fighting somebody, but who's been to that point where you're like, I got to get out. And the second you get out, that thing turns up and you're like, yeah, it gets me every time, man. Right? Don't do it. So that's the lesson of today. It was a lot, right? So I didn't plan on, bothering you guys all night. I appreciate you guys hanging out. I will attempt to take questions if you have any. This is exactly how we do our normal Wine and Wealth class. I just go through everything I want to share. That was a little bit longer than normal. And then I just hang out and take questions there. So if there's anything I can help you with, I'll take my shot. And if I don't know the answer, we can ask Eric or something. And again, for those of you that are like, well, this is different, you want to check us out at Jazz Wealth. Obviously, that's why we're here. It's a bit of a marketing pitch tonight as well. But you won't be disappointed, right? Because my thought every single day is, how do I add more value? It has to be as an advisor. With the investments are going to do what they're going to do. I can only adjust them so often. So every day, whether it's a tax tip, like last week, we did cool little back of the envelope sort of tax tricks that nobody really knows about. It could be something teaching you about trading, anything. I love to add value there instead of just doing whatever other advisors do. I don't know what they do. Yeah. Hey, what about the war? Oil and therefore inflation has to do with the war. Yeah, darn Putin, right? That guy, right? It's all his fault, isn't it? The whole thing, 100% of it is all that guy's fault. If I ever meet that guy, no. So where we stand now is, yes, rising gas prices here in the States are affecting our markets and affecting our inflation. Inflation is a big deal all over the world right now, but who cares about those people? We're dealing with our dollars, right? So that's the mindset. That's the mindset I would take. What's going to put a floor in the market is that first dip in gas prices, which we will have. May not be over the next couple weeks, but we will have that dip. And so that will get people to start thinking, well, that means the inflation number's coming down because energy is a big component of inflation. Well, Tim says, ride the market down, ride it back up. Well, we're all going to we're riding the market down, right? But while you're riding it down, take advantage of it. Does it mean adding 1% in your 401k? Does it mean doing a partial conversion? Does it mean doing some tax loss harvesting? Right? There's things you can do while the market's going lower. You don't have to just stare at it and go, well, that sucks. I should have done something different. No, there's stuff to do on the way up. There's stuff to do on the way down. Your net worth does not stop and go lower just because the markets went lower. You play that strategy for you say, well, 2 years from now, I'm adding that to my net worth right now. I'm going to do that. Yeah. Hey, Maslam, when you said you were going to hold cash for a time earlier, is that literal cash or do you put that money into a bond fund or something like that? It is as close to literal cash as possible. The cash is inside of our funds. So if you ever see like a mutual fund and they're like, we're 80% stocks and we're 15% bonds or whatever. And then we got 5% in cash and cash equivalents. It's basically just like a high interest savings account. But it is cash. Love your shows. This is how financial shows should be, not the goofy entertainment crap. Oh, I appreciate it. Yeah. I thought you was calling me goofy. I'm only a half a glass into Goofy, man. You ain't seen Goofy yet. And there's Carolyn. Miss Carolyn, how we doing tonight? Good to see you. Getting rain down there, are you? King says, well, here's a question. I wanted to do just a passive investing long-term 20, 30 years. Would you say you could buy Qs, VU, and keep averaging into those three? Well, so passive investing, the way you're using that term, you're meaning I don't want to look at it. I just throw me in there, pick something and go for it. This is a long shot, but I often suggest the Qs and SPY, not so much the Vanguard products, because you never know. This may not be the case, but you may get to a point in life where you say, I'd like to have passive income on my investments, and those two are much easier to do that with than some of the Vanguard products. Not that they're bad, they're just not set up for that. So if you had to pick, I would lean you that way and say you may not even care for a while, but if you should happen to care one day and you have a large position, that's going to be well worth your while. Being retired, cashed out with no taxable event, just left it in the account. I feel like we're at least 45 to, yeah, there you go. Yep, that's what I'm talking about. Now, Joseph, what you going to do? You going to scale in a little bit, or are you saying, no, I need this cash, man? That's understandable, but I'm just curious. Kevin, when you're overweight in a stock versus ETF position, such as 90% in one stock, 10% in ETFs, what are options for risk management, or is it too late and just stay in the roller coaster? Well, if it's right now and you're 90% in one stock, I can't think of a stock that maybe Raytheon would be the only one I would say, I hope it's that one. Otherwise, you're on the roller coaster. You're living it. We're on the downhill slope here. So it's definitely a lesson learned there. And don't kick yourself about it. I mean, it could have gone the other way, right? You could have been sitting there going, this is great. I got 90% in one stock and I'm killing it. But yeah, once the damage is already in process, unless you're going to use options or something, it's very tough to do anything. Hey, where can you get a copy of that theme song? I actually don't know I can't hear the song, so I'm like bobbing my head and everything. I'm faking it, I'll just be honest with you. I told you we're transparent. I can't hear the song, so whatever song it is, you'd have to ask Cody. Wherever we got it, it's a free song though, so happy to tell you. I just don't know which one it is. You got one question. Are you starting to buy from the medium cap fund? What's your strategy in layering in? Yes, that is next, actually. So I've been very patient with that one, thankfully, and it's paid off. Mid-cap is next. We're going to make that next week's class for clients. So I'm actually going to do like I did the small cap fund. I'm going to go through each stock maybe you've never heard of, and share some ideas there so you can see. And that's going to be one where we're basically going to take 2 or 3 shots at it. That's not going to be like a 2% in here and there. We're ready to take our shots. Trading with a dummy. Hey, man. I understand the historical data, but like COVID dip and market reaction being an anomaly, this one could be one as well and last much longer, right? See nothing positive moving the market. Very well could be. How would we know? How would we know at what point is this an anomaly? Is this more reason to be fearful? Is this like, oh, we got it wrong, let's run away? How could we determine that, right? There's actually a moment you can do that. I'll go here and show you this one. So if we know that the market tends to hit a bear market and then here it falls 8% more, and I showed you this, right? If we know that after hitting 20%, that typically we fall about 12% more. So in other words, a 32% drop in a bear market is not abnormal. That's the point where you say, this is odd, right? And you have to go to these special circumstances here to find the actual odd events, right? It'd be the same thing. So you look at something like that and say, well, if we start bouncing here and then just flounder around for a while, there was nothing odd about this bear market. It's one to leave in the record books, and we'll chalk it up to learning and everything from there. But if we were to go past that and not seem to recover, that's one of those moments where you could say, okay, this is different. This is definitely different. Yep. Oh, yeah. Monty says the third advisor team can't say nothing but, oh, that's nice of you. Thank you. I appreciate that. What do you think about a recent 3-day move in bonds? Are they becoming again a hedge to falling stocks? I mean, for goodness sakes, right? Like we did a class on this a while back. To have the stock market and the bond market not just pull back, but correct and then bear market scenarios there. Well, that is rare, right? So think about the 50-50 portfolio, 60-40, 70-30, whatever you're doing, your target date funds, right, in your 401k, crushed. Because there's no lifeline. Normally what happens, and this is why they tell you do 60-40, 70-30, or whatever you come up with, it's because when stocks do bad, bonds tend to give you a little bit of a boost. If bonds have a rough patch, that's because stocks are doing well. Not the case this time. It was both of them down at the same time. Horrible. Now, the last couple days of just watching it pull back, that is purely just an overextended or oversold bounce. That's all it is. That's what the stock market's going to do next. We'll have a oversold bounce that will mean nothing. We just saw one last couple of weeks there, 6% in 5 days, right? It was just an oversold bounce. It meant nothing, and that very well could happen again. So I take that to the bond market and I say, I don't see why we should have a decline in rates right now, which would cause prices to go higher. That will change at some point. But I couldn't comfortably say that now. Oh. Yep. JW, you have anything odd about this year you think would cause it to go a ton lower? I don't think we get to 2007 worthy drop. Yeah, I don't think we get to 2007 levels because we're nowhere near that same boat, right? There's not a pending crack that's turning into a crater sort of thing. We're dealing with just inflation and what will be a slowing economy, I guess. But no, I don't see anything odd there so far. No. Especially you get home prices refuse to budge. We're getting spoiled with these home prices. Yep. Oh, nice. Nice. I-bonds, I see that listed a couple times there. Yeah, just know what you're getting into, right? It's there's this something going around on the internet, I don't know, whatever it is, but when somebody suggests something like, ooh, those index universal life policies, get your whole life and, oh, that's what Disney did, right? That's what the Rockefellers did. No, that's what the internet tells you they did, but that's not accurate at all. So people see that stuff and they go, I want one of those, right? It's the same with I-bonds. Somebody says I-bonds, they're always popular during higher inflation, but some of you aren't even old enough to have known the last time you could buy I-bonds, almost me included. But yes, so just know how they're treated. How are they federally taxed? They are federally taxed. Did you know that? How are they reset, right? Take a minute and just read about it before you go throwing 10,000 at it. Hey, Tustin, can you explain it again? If you buy the S&P, you should buy the SPY. Now, doesn't VU have a lower expense? No, come on. Like, if it does, what is what? So VOO is 0.14. Okay, so we're talking pennies here. And SPY is 0.09, right? If this is accurate here. So no, it does not. I think at times it has, though. If I'm being fair there, I think you're probably right. At times it has been more expensive. The spiders. Is Q's the best fund for the NASDAQ? Well, it's impossible to say that it's the best one because it's an index fund. So that's why people like Kings there just compare prices. Because index fund and index fund, they're just doing the same thing. So it doesn't make one better than the other unless they're substantially different price-wise. But you don't normally see that. Yeah. Can we have a wine and wealth class again for members when you think it's time to buy? I'm saying that right now, Natalie. That is time to start scaling in there. I'll be more specific, of course, in the next class. But yeah, I was saying that earlier too. I just laid out all the stuff too that makes you go, yeah, got to get in there. Got to show off the towel. Where is that darn towel? I got all these towels. I'm the only one here tonight. I can't grab the towel. Sorry. Yeah. You think I-bonds are only good for the next couple of periods? Yeah, I hope you're right. That means inflation came down quickly. You think the semiconductor industry is the best investment in this area? No, I think the semiconductor industry has oversold on the shortage. You know, the whole chip shortage that we went through. Is moving funds from, let's say, Ally to invest in Jazz, is it worth it to do it now or wait till year to date is closer to zero instead of negative? I see what you're saying. It doesn't matter to me. You are allowed to say, hello and welcome. I'm here. I'm going to join Jazz Wealth. Here's my account. Please don't sell anything just yet. Just hang on to it. I'll get back to you. You're allowed to do that. And you can even, we'll do the transfer for you, but we'll even ask them. We'll say, oh, so-and-so wants to transfer his account over here. Don't touch it. Just give us the positions. We'll deal with it. And that way we work together on it too. That's the cool part is you may want to sell something and I'm constantly researching this stuff. All of a sudden I go, no, don't sell that one yet. You know, let's sell something else. So you kind of get two eyes on it. Yep. I know. Sector is part of the dojo. If it were up to me, I would get rid of all that. Joe, sorry. I don't mean to upset you, but that's such a pain, little sector there, or the part of the platform. But hey, does SQM? Oh, so I don't have a way to actually look. Let's just use like FinViz or something. So the question's on SQM. You're looking for it to continue to dip. Yeah, what a great one there. So nice little pullback after that. So that's the beautiful part about that one. That is not like the XLE or the energy market where it just rips and rips and rips and rips and you're like, gosh, when am I going to get in? SQM is a normal, like it's behaving normally. Breathing in a little, breathing out a little, breathing in, breathing out. I'll take that all day long. Yeah, you don't even have to get close to the bottom or anything. Just to be in something that's behaving normally, I like it. Whereas your energy, right, just rips 60% plus, and then all of a sudden falls out of nowhere. How do you get excited to buy that? You know? What's your thoughts on people investing in the SPLG ETF versus SPI due to being a fraction of the price with not a lot of money? The price doesn't move me much. So if something is $200 and the other thing is $15, it doesn't matter. I would go with whatever fits the need for that mission, because the fractional shares take that away. You could just buy a dollar amount of it instead of a share amount. Yeah. I hear you. Yeah. Give you something to think about, huh? I love it. Well, I hope I gave you all something, at least that you've learned, right? Whether you're thinking about it or not, or whether you already knew it. Just a little bit of a show and tell tonight to show you how we do things here. I really appreciate you guys hanging out because, you know, I know you probably have other things to do. I've been having fun with these later night videos lately too, so maybe sneaking in a few more of those, but it is also getting ready to come down. I don't know if you can hear, and it feels like it's a little bit choppy here anyways, so I'm going to probably wrap it up just so we can count this a success. What happened to the nest egg login from the Jazz website? We're moving it into the dojo. Yep, just trying to make it where everything's under one roof, so you don't have to log into a bunch of stuff, you know? Working on that. Anyways, I will wrap it up from there. You guys enjoy the rest of your evening, and we'll see you next time, right? Remember, jazzwealth.com if you want to check us out. If not, you know, that's cool. No hard feelings.